then I
Okay,
should.
so let me share some thoughts on selected aspects of the banking crisis and the Indian economy. Treat some of these things as hypotheses, if you like. So, a quick introduction, I forgot. So this is Samiran Chakraborty from City Research, Nirupama Kulkarni from CAFRAL, Mumbai, and Prasanna from ICICI. Welcome to all of you. It's really nice to have you here. Thanks for taking the trouble and coming over. So let's ask the basic question. Do we have a banking crisis? It is true that there have not been any major bank runs. There are many profitable private banks and some possibly excessively profitable banks. There is hardly any contagion from the most affected public sector banks and cooperative banks. However, we've had non-performing assets that stood at 14.6% in public sector banks. These NPAs have resurfaced in recent years after the period around 2000, are apparently huge in cooperative banks, are possibly large in non-bank financial companies, maybe large due to the recession in the real estate sector, and are expected in the Mudra scheme. And there have been sizable withdrawals as well from short-term funding at NBFCs, and a 14% decline in current and savings accounts, CASA at Yes Bank. And last but not the least, substantial credit slowdown, at least in public sector banks and also in very many NBFCs. So that leads me to say that at present in India, there is a quasi-banking crisis, if not a banking crisis. Here is some data on NPAs, and there is one part which is familiar, that is the newspaper story. The other part of the story which some of us may have forgotten is that they used to be high earlier as well. It came down and then it's resurfaced. They were high elsewhere too, but there they have declined and they have not gone up. In our case, they have. And to come to the issue of credit slowdown, you can split it up into demand side and supply side. So is it a demand side problem or a supply side problem? Now the textbook story of credit rationing is that everybody doesn't get credit, some get credit, others don't get credit, and you don't have interest rate as a market clearing mechanism there. And the idea there is that those who get credit are more credit worthy, either as managers or as projects, and the others who don't get credit are not credit worthy or less credit worthy, which is why they are rationed out of the market. Now the story in India has been very different. We keep hearing the stories of people who are not very competent who got bank loans, people who didn't have good projects and they got bank loans, people who indulged in frauds and got away with it, at least then. So we don't have this ideal allocation of credit between those who got them and those who didn't get them. Now that is the sad part of the story, but there's a silver lining here, looked at from this point of view at this stage, which is that there should be demand for credit. Why? Because the people who did not get credit earlier were actually credit worthy, they did not get them. So now to say that there is no demand for credit is not being fair to a huge population of businesses in India. And this is particularly true in sectors less affected by growth recession. This is just one example. One could think of other examples. So if it is not a demand side problem, then, why the credit slowdown? So let's come to the supply side. So this, by the way, includes some historical background also, and you will see why I need that. So it was initially affected by the transition to inflation targeting. The growth rates of reserve money, it's not well known, had come down substantially quickly. So from 21 and 14, they came down to 5.9 and 8.8 in a short span of time. And that affected money credit in the economy. That was the early days. So, and this transition can also explain the significant and somewhat prolonged rise in real interest rates in India. Supply was subsequently affected by the more familiar things: asset quality review, humongous NPAs, reduced bank capital, prompt corrective action, and delayed recapitalization in banks. Effective supply is also, it appears, affected by the lack of homework for new and different borrowers, the point that I was making towards the end of the previous slide. So, coming from the banking crisis to the economy, before I relate the two, here is a chart on the economy. This is very simple. It just means GDP basically. So this is the focus currently. I just want to point out one thing, that looked at in the long-term picture, this doesn't quite stand out as something very exceptional in the longer history. That is one. The other is that, do we treat this as an aberration, or do we treat this part as an aberration? Now, to relate the two, the quasi-banking crisis and the economy, correlation and that's causality. So, of course, there is correlation between the quasi-banking crisis and the economic slowdown. What about causality? Is it from banking to the economy, or is it the other way around? Now here, so what I'm saying is that the earlier slowdown caused the recent quasi-banking crisis, caused, not exactly, take the arrow to mean earlier slowdown contributed to the recent quasi-banking crisis, and the recent quasi-banking crisis has contributed to the recent slowdown, and also the recent slowdown has contributed to the recent quasi-banking crisis. So, which is why these arrow in both directions here. And so why did this earlier slowdown matter so much? The earlier slowdown mattered so much due to the nature of the banking system and the nature of the investments in the boom that had happened. And why the earlier slowdown? Well, history matters, and here is an important line from Crockett: boom sows the seeds of a downturn. So the earlier slowdown was partly an after effect of the general boom 2003 to 2008, the excess stimulus 2011, and the big and long real estate boom till about 2012. And why the recent economic slowdown? Two main shocks, the quasi-banking crisis and the various long-term supply-side economic reforms that have acted as short-term shocks that have adversely affected aggregate demand. So you see in this one statement, supply and demand, it's not a separate thing here. This appears to be at the root of, or at least an important part of, the so-called demand problem in the economy. Now, just to list, this is not a comprehensive list, but it does include the important ones, economic reforms that have adversely affected demand in the economy. So this is the government intervention in the IL&FS case, that the GST, Goods and Services Tax, Benami Transactions Amendment Act, Insolvency and Bankruptcy Code, IBC, Real Estate Regulation and Development Act 2016, demonetization, which is the most well known, but just to point out that that is only one of the items in the longish list here. Inflation targeting, asset quality review, the Land Acquisition Act 2013, Supreme Court judgments in 2012 and 2014 on 2G spectrum and coal. And you will see why I am including these things here. So this is going back in time. So how did reforms adversely affect economy in the short run. So let's start with this basic thing. Aggregate income GDP is wages plus interest plus rent plus profits. It's important to note something that is obvious, we are all familiar with, but it has an important implication here, which is that in the short run, wages, interest, rent tend to be relatively fixed. It's the profits which take the hit. These are the residual. So now, when you look at it as this, then profits as a subset of GDP, that is the accounting part, but profits can be a determinant of GDP, and that is the argument that follows here. So reforms, and I put it in inverted commas because if reforms are having an adverse effect in the short run, then there is a slight question mark on the positive part of the reform taken as a whole. So the reforms act as a shock on the profits. So if you take for example, the cancellation of coal and 2G spectrum allocations, or you take some other of those things that I put out in the list, they immediately hurt profits, and profits affect the internal funding for investment, and investment in turn affects GDP. This part is very familiar. This part is less familiar. So also it affects external funding because the profits affect stock prices. I'm not saying profits are the only thing affect stock prices, but they sooner or later affect stock prices, and that affects external funding, and that affects investment and GDP. So here you have a reason why investment was falling, and this is consistent with some literature that we have. And to give you some data on how the profits had been affected, we are very familiar with the GDP growth slowdown, but if you take the profits, the average rate of growth of corporate earnings per share EPS for BSE Sensex shares is 5.16% over the period 2008-18, 10 years. In real terms, it is minus 1.88%. Now, even if you take a different composition and a different data set, the numbers could change slightly, but the broad stylized fact is that profits have been very adversely hit in the last 5-10 years in the economy. So, policy, two guiding principles for policy for macro financial stability: stability with minimal, if any, financial repression, bailouts, and misplaced confidence. And policy not just in a slowdown but also in a boom. We talk about counter-cyclical policy, so it should be meaning that you have a policy not just in a recession but also in a boom. The policy in a boom part often gets forgotten. The boom is often interpreted as a jump in the long-term permanent growth rate, which may or may not be the case. So, policy for macro financial stability, I am talking more about the banking part here. So, minimum statutory liquidity ratio we are familiar with. Das Gupta spoke about possibility of a maximum SLR. So, what that means is that you have a cap so that the banks cannot hold too much of government securities, and therefore they have to lend, and that keeps the economic activity and lending going. A new interest rate policy that could have a positive effect on short-term funding, in the sense that it would discourage short-term funding of NBFCs. I'll be more than happy to talk about this if anybody is interested, but this is not the occasion, so I'll skip that. There's a trade-off if banks have low capital. If banks have low capital and you recapitalize them, then it can pave the way for bank lending and economic activity. However, that recapitalization can affect, it can lead to moral hazard, so there is a dilemma. Now, every now and then public sector banks have gone through this, and the government of India, and possibly rightly so, they take some time before they decide on what to do, and when they recapitalize, it's after some gap, and meanwhile there is a slowdown in bank lending and in the economy. What is the answer to that? Is denationalization of banks an answer to that? Because the NPAs, etc., seem to be primarily in the public sector banks and also cooperative banks. And higher capital adequacy instead of higher deposit insurance. Again, I'll be more than happy to talk about this, but I'll leave that out. Just to mention that the FRDI bill seems to be back on the table, of course, with the change that deposit insurance would be revised to possibly 5 lakh rupees instead of 1 lakh rupees. And what about monetary, fiscal and other policies? I'll be very, very brief here, which is just to say that there is need for greater care in economic reforms, more so when monetary policy and fiscal policy cannot go beyond a point. I'll end there. Also, you would like to? Yeah.
Okay, so just take you through it from a financial flows perspective and then kind of link it to growth and then kind of end with by saying what should be done or what I think should be done. One interesting data point which probably doesn't get discussed is that if you take bank credit to GDP, it is kind of almost flat for the last 1 decade. And it is the non-bank part, that is when you add bank and corporate bonds broadly, that is the part which has grown. So it is the non-bank part of the economy or part of the financial sector that has kind of helped growth in the last 1 decade. So this banking deleveraging is actually it's going on for a very long period. It's not just a story of the last 4 or 5 years. So when banks were repairing the balance sheets, it's the non-bank, which is basically the NBFCs and the corporate bond market, which funded growth. So the chart on the right, if you see, it kind of breaks down. So the blue bar is the bank credit, and the red bar is the NBFC credit. So NBFCs also borrow from banks, and they also borrow from market, and then they lend further. So we have kind of split that to show that how much banks supported NBFCs and then NBFCs got from the market. So you can see that post demonetization, basically NBFCs lending actually surged, and it was not because of banks. They actually went out and borrowed in the market and they were able to lend. And then of course after ILFS, that thing completely flipped. The markets pulled back, and therefore the dependence of NBFCs on banks again increased. So broadly our sense is that the non-bank expansion has run its course. But now the question is, are the banks ready to step up? So if you look at the sectoral deployment of credit, break it up into different segments: agriculture, services, industry, personal loans. Obviously the personal loan component has always been very strong, which shows that obviously the consumer segment is underbanked, and therefore there's a lot of scope there. But also the services part, it surged last year and it's come down. So the loans to NBFCs come under services. So that's why the surge happened. So again, if the annual numbers, if I kind of break it down into 2 halves, first half and second half, the bank credit, there's a very strong seasonal element, right? First half credit growth doesn't happen, second half the growth happens. I'm talking about the incremental credit. So last year was a bit unusual. We saw a rise in the first half also and in the second half. So what happened was that, obviously banks were coming off on the back of demonetization, and generally there was a pickup in credit last year. But also once the ILFS crisis hit and the NBFCs were kind of drawing down the lines from the banks, and banks also kind of went out and purchased loan pools from the NBFCs. So it is possible, and again here it's an hypothesis, I have no way of proving it. There was also a political imperative to keep the shadow banks alive. So because one of the banks, Diwan, became bankrupt after the election. But immediately after ILFS, I think it was an open secret in the market that it was a matter of time. But it was kept alive through the election, and then later it became bankrupt. So it's possible that there was some directed lending. Banks were told to lend, and that's why the credit surge happened last year. And now there is a payback this year. Again, if I break up bank loans between government-owned banks and private banks, it's interesting. The private bank credit growth in private banks has always been on the higher side, but I guess the last couple of quarters, even there, the slowdown is visible. One of the problems for PSU banks is that actually there are a couple of problems. There were restrictions by RBI. So the banks which had very high NPA ratios, there were restrictions put by RBI. Also, the government was very slow to release capital, so which kind of put a constraint or put a boundary on how much the PSU banks can grow. So again, the other way of splitting credit growth is between credit growth to NBFCs, credit growth overall and credit growth ex NBFC. So again, you can see that the credit growth ex NBFC has not grown so much. So the surge, a lot of it came purely from the NBFC lending last year, and even that has kind of slowed down. So where do we stand in terms of NPAs? I think Gurbachan already covered it, but just this is the data for 20 large banks. We took 14 government banks and 6 private banks. These are essentially the banks which matter. So the overall NPAs plus restructured loans, which are the stressed assets, it should have peaked. It has peaked, but what could happen now is that the bank exposure to the shadow banks, right? From there, new points of stress can come out. So if you see the chart on the right, the NBFC and the HFC NPA ratios, that clearly tells a story. So clearly there is something fishy happening in the HFCs, right? I mean, HFCs cannot have 1% NPA ratio, and the bank's NPA ratio is so high, the NBFC NPA ratio is also higher. So a lot of those bad loans in these balance sheets have not been recognized. So as they get recognized, I think the bank NPAs can also go up. Now, what can be the impact on the rest of the economy? So this, to look at it, you look at how much exposure the rest of the financial system has to shadow banks. So obviously the 3 big groups, or the group of entities which have are banks, mutual funds, and insurance. So if I kind of add it up in terms of percentage of GDP, the total exposure is around 7.5%. This is the exposure of these entities to NBFCs and HFCs. If the NPA levels in the shadow banks keep going up and they reach the peak where the peak of the banks, the calculation is the hit to the economy can be close to 2% of GDP. Now, this will be a hit spread across banks, insurance, and mutual funds. So probably about roughly 1/3 of that will be a hit on the banks. So again, looking at some of the individual NBFC and HFC names, what is happening in terms of their credit growth? NBFCs seem to have done well. At least one NBFC, Bajaj Finance, is in a different orbit. It is completely consumer focused. The other NBFCs have slowed, but they're still growing. But if you look at the HFCs, they're clearly hit very badly. So the problems could be concentrated in HFCs. The top 10 NBFCs and HFCs account for 2/3 of shadow bank assets. So when people talk about there are thousands of NBFCs, how to solve this problem, actually this problem is kind of concentrated. So if there is a will to solve it, it can be solved. Okay, I think we're running out of time, so I'll kind of skip through this. The general idea is, although the credit to GDP, the household credit to GDP is on the lower side, the non-bank share of that has been growing up. So non-banks have a significant market share in individual loan categories. So now as the non-banks slow down, there can be a slowdown in that loan growth, and that is seen in high frequency data like vehicle sales and IIP consumer durables. Again, per capita consumption growth, these are all from National Account Statistics, has always been faster than disposable income growth in India. And like I said, because the household leverage is fairly low, that is always possible as long as consumer confidence is high. But you have seen that consumer confidence peaked around the time of elections and it's come down. So obviously the willingness to take loans has also gone down at the margin. So what is happening to the economy? Again, growth slowed down into Q1 and Q2 in the current quarter, that is the October-December quarter. We do think there is some marginal pickup. Nothing to get too excited about, but still it seems like Q2 was the bottom. Of course, one problem for us this time is that the weakness is like across demand categories. I mean, whether it's consumption, investment, or exports. So that is the worrying part. Earlier, consumption was slightly stronger in India compared to investment and exports, and therefore that was keeping the growth afloat. So broadly, like I said, growth might have bottomed out. This year, full year growth could be around 5%. Next year, we are penciling in a modest recovery. What is supportive? Global backdrop on monetary policy, but risk aversion in the financial sector is still there. That has to be fixed. There is no clarity over fiscal policy, so that will help. So briefly, what can be done? Again, like I said, the banking stress may have abated, but new sources can emerge. One of the problems on the banking side, according to me, is the public ownership of banks, the poor credit culture and the stretched out NPA cycle. So I think there is a need to move to a holding company structure. Nayak committee report, which is already there in the public domain, and it's not to say that private sector banks are fine. There are governance issues there that should be addressed. Non-banks need attention, but I also think there shouldn't be any bailout because the bailouts will only address the symptoms. The problems are on the asset side. I mean, we didn't have time to go through it, but briefly, it is the real estate and power sector which are the cause of most of the problem assets. So unless you fix those sectors, just bailing out won't help. I think some of the problem entities, and I would say there are only 4 or 5 of them, should be identified and they should be sent for resolution or liquidation. And then the rest of them, then the market will be clear that the problem is kind of been isolated. So the market will be more willing to lend to rest of the entities. And there should be a regulatory overhaul also. I don't think we can have a light touch regulation and allow these entities to grow too big, because then the too big to fail concept also comes in, and these two things don't go together, right? So if you want to experiment as an NBFC, you do it, but you do it up to a size. Beyond a size, you have to convert to a bank. So obviously, and meanwhile, to cushion growth, RBI should take the lead from MPC. I think there should be balance sheet expansion since the price signals are not transmitting, and it looks like RBI has already started doing it with their announcement yesterday. So hopefully that should help push transmission. So broadly, this is it. I have not tackled fiscal policy because that will take the discussion to a different orbit altogether.
Okay, great. Thanks for having me here. The usual disclaimers apply. So the previous talk has already spoken about this, but basically, where are we now? There's been a severe slowdown. The debate is it structural, is it cyclical? And probably it is structural. There is a twin balance sheet problem. That is, the banking sector is doing badly and the corporate sector is doing badly. And this has now spread to the NBFCs. So recently, India had its own Lehman moment with where the IL&FS crisis basically revealed massive exposures of the NBFCs to real estate. And now there has been reduced lending to the NBFCs. So some people say that maybe there is this balance sheet problem. That is, there is this crisis in the original 2 sectors, the banking sector as well as the corporate sector, and now it has spread to the NBFCs and the real estate sector. And our usual solutions don't seem to be able to fix this problem. That is, on one hand, monetary policy it seems to be broken. We cut rates by about 135 basis points, but transmission has been lowered. And there is limited fiscal space. And I'll come to this in later slides. And in light of all this, the stock market exuberance, I think, does not make much sense. So there is severe malice with deep roots in the banking sector. And so the question is, how do we fix it? Now, I do more academic work, so it seems that history repeats itself, and every few years we come at the same crossroads and the same solutions keep being brought up. And I think it makes sense to go back and look at what has happened in the past, because I think it will help us make a little bit more informed decisions going forward. And as the saying goes, insanity is doing the same thing over and over again and expecting different results. So let me just structure on what I'll talk about. So I'm going to first talk about the forbearance schemes. Very recently, the government issued a directive to banks to not recognize distressed loans of the MSMEs as stressed or as NPAs till March 2020. And but we know from a large literature that forbearance does not work. In fact, it does more harm than it does good. And so I'm going to look at the forbearance schemes in the 2008 onwards, and basically that you can also think of as how did we get here, or what not to do. Then I'll talk about some possible solutions to resolving bad loan problems. We have tried a lot of things in the past. So there is alphabet soup of legislations which have been put out. So I'll talk about the learnings from each of those things. And then I'll just bring up two main challenges. One is that we have a largely state-owned banking sector, and two, that we have fiscal constraints. So what are the problems that arise when we ask the government to do too much? And finally, I'll conclude by talking about whether bad banks can be a possible solution. Okay, so is regulatory forbearance ever a solution? And this quote by the then DG, the then Deputy Governor at RBI basically says that maybe our NPA crisis was caused by all the forbearance schemes that preceded 2017. And forbearance basically has these dueling incentives. On one hand, what policymakers think is that it will help borrowers tide over temporary adversity. But on the flip side, it can also be used for regulatory arbitrage. And we know this from prior literature. So these forbearance schemes are essentially stealth recapitalization schemes. And we know that when we give capital to weakly capitalized banking sector, then what ends up happening is that lending quality tends to deteriorate. So what ends up happening is zombie lending increases. So zombie lending is basically lending to otherwise insolvent borrowers who are neither dead nor alive. And we've seen this in Europe, in Italy, in Japan, and even in the US. And so in one of my papers with Anusha Chari and Lakshita Jain, we basically look at the forbearance schemes that were introduced between 2008 to 2013, and then we, how is this forbearance operationalized? The provisioning for restructured assets was the same as that for standard assets. So banks could restructure maybe their bad loans, and then they could just treat it as if they were standard assets. And subsequently, this was removed after Raghuram Rajan became the governor in May 2013, and this became effective in 2015. And so what we are going to study is both the implementation of forbearance and the retraction phase. So we want to look at the long-term effects. And so let me talk a little, just talk about the left-hand side graph. So what we find is that the restructured assets increased sharply during the forbearance period, and this was especially true of public sector banks. And when forbearance was removed, there was a small decline, but this did not completely revert. And so broadly, we find that there are perverse effects of forbearance. So there is credit misallocation, lending increases to low solvency firms, that is perhaps not the intended beneficiaries. You wanted to go to low liquidity firms. Zombie lending increases. There is credit market distortion in the competition for credit. So the non-zombie, the healthy firms get less credit, and these effects are persistent. And this we sort of know from the prior literature. But what we also find is that there are permanent changes to the banking sector. So what ends up happening is that bad banks lend to bad firms, and the good firms actually go to the good banks. So once you've removed forbearance, what ends up happening is that you have this bad matching. So usually what you do is then you come and recapitalize, but by then it's too late, because now you're just directing credit to bad banks who are now attached to these bad firms. And so what are the possible solutions? So I'm going to look at a couple of things that we have put in place. So first, in this paper, I analyzed the effects of the SARFAESI, which was basically a collateral reform that allowed creditors to seize secured assets from defaulting borrowers. And what this did was it actually took credit away from the zombie borrowers and redirected it to healthy borrowers, and overall productive efficiency improved in the economy. So maybe the possible solution is that improving creditor rights and resolution of bad loans can lead to a bad loan situation. But there are some caveats. So in a subsequent paper with my colleague Aditi and other authors, we look at what happens after the implementation of the recent insolvency and bankruptcy code. And we find that there is an increase in recognition of zombie loans as NPAs, but these effects are very weak for weakly capitalized banks and weak for public sector banks. However, we compare that to a subsequent unconventional regulatory intervention, that is the February 12th circular, which removed all lender discretion in whether they could recognize a zombie loan as a bad loan, as an NPA. And we find that this actually undoes many of these muted effects. So we find that there's a significant increase in the recognition of zombie loans and NPAs. However, there still seems to be a problem with the PSBs. So the takeaway here is that there are, even when you have these improved creditor rights, there are perverse incentives of weakly capitalized banks, but unconventional regulation can help. Okay, and so now, and again, the bad news is the Feb 12 circular was rescinded because it was declared unconstitutional. And so now we go back to a prior legislation, which is the NPA ordinance, which basically allowed the RBI to go and tell banks that you need to pursue these delinquent borrowers. And this is just a policy piece, and we just look at stock market reaction. But broadly, what we see here is that this seems to have been treated as positive news for the stressed banks, and it seemed to have be treated as positive news for the good firms in the economy. Okay, so what are the challenges? So one is that our banking system is largely state-owned. Now, one argument for having them in place is that they tend to do more, they tend to lend to disadvantaged sectors. But we know from prior literature that there are the sector is actually plagued by many inefficiencies, and much of the recent NPA problems have been driven by the public sector banks. So here, if you look at the ratio of NPAs in public sector banks, this has been higher than the private sector banks, and this has been increasing over the years. But in addition, in these two set of papers, there is another additional thing that we need to keep in mind. That is, there can be negative externalities of having these state-owned banks. And in this paper, what we find is that in areas, in districts where private sector banks were more exposed to state-owned banks, around the Lehman crisis, there was a flight of deposits away from private sector banks to public sector banks. And this basically occurs because public sector banks are government-owned, and we find that the flight is actually to the more vulnerable or the weaker public sector banks. And so, because these are government guaranteed, the market discipline actually breaks down. So one can argue that, okay, that is fine if these banks also increase the credit because there are more deposit inflows. And what we actually find in a subsequent paper is that the lending of the public sector banks increases, but to worse quality firms, and overall productive efficiency again declines. And so the takeaway, and here these two graphs basically say that around the Lehman crisis, there was the public sector banks outperformed private sector banks, and similarly deposit growth of public sector banks exceeded that of private sector banks. And this almost started during the Bear Stearns crisis. And so what the takeaway from this set of papers is that the PSBs actually exert negative externalities. And especially in this kind of current environment, one thing we need to keep in mind that there might be deposit flows during crisis periods. And the other thing is that this is especially problematic because we know the banking sector is especially weakly capitalized, and we know that when they get these inflows, that weak banks, when they get inflows of deposits or capital, they tend to lend to the worst firms. Okay, and the second challenge is the crowding out effects of government financing. And so India has now moved away from, this is just the last slide. India has now moved away from borrowing directly from the RBI to market-based borrowing. And, but this market-based borrowing can have significant crowding out effects. So, you can see this in the United States as well as in India. So here we plot government debt to GDP and the leverage for corporates, and these are moving in the opposite direction. And similarly, when we look at in the right-hand side graph, we plot bank credit to government debt, and there's a negative relationship. So this is not just unique to India. We see this in many countries. So the part that is, I think, important in the Indian context is that one, because we're a bank-dependent economy, the way the crowding out actually works is that public sector banks end up holding more of government debt when the government issues more debt, and so the public sector or the banks in general, and then they lend less to the private sector. But in addition, sometimes the PSBs are asked to fill in for government spending, and you see this in the infrastructure spending in the mid-2000s, and as a result, there's less left to lend to the private sector. And let me just conclude. So how do you resolve the bad loan problem? One is we should fix the fixed loan resolution, that is fix IBC. I think we should revive the Feb 12 circular. But while that is being put in place, maybe we can use the tool that we already have, that's the NPA ordinance, which basically asks the RBI can direct banks to pursue delinquent borrowers. Bad banks does seem to be a solution. This is not a bank holding company per se, but an asset management company that works on the resolution of stressed assets. And of course, the integrities need to be ironed out. So things such as the right incentive, the right price, the right amount of government intervention all need to be worked out. But what this will end up doing is that it will clear up bank balance sheets from the overhang of stressed assets. And once we have done the hard job of recognizing these bad assets and taking it off our balance sheets, we can then do recapitalization schemes. But then again, this needs to be tied in with performance. And I have said a lot about how much of the problems that we saw was in the public banking sector. And let me end on a positive note. So this paper by Prachi Mishra, Prabhala and Raghuram Rajan basically looked at the introduction of credit registry in India and found that the PSBs actually, after this new information on their borrowers became available, the PSBs actually use this information for the new lending. But for their old borrowers, they did not use it. So Geeta Gopinath was recently asked, what she thought about the NPA problem, and she said that this is not just a stock problem; it's also a flow problem. And from this paper and what we have seen till now, the implication is that perhaps if we solve the problem of legacy assets, then maybe we will fix the flow problem. Thank you.
Hi, good afternoon everybody. I'm Samiran and thanks for this opportunity to come and speak to you. Apologies, I don't have a PowerPoint, but I think my face is nice enough for you to look at for 10 minutes. So I think the way I look at India's growth over the last few years is it has been entirely a consumption-driven growth. And at least the numbers that we track don't seem to suggest that this consumption growth has been caused by either a significant job growth or a significant income growth. So the only explanation then seems to be that it is based on higher consumer leverage. And that consumer leverage could come from two things. One is the consumer might have reduced his savings or her savings, or the consumer might have borrowed more. And in Indian context, both the things have happened. The consumer household savings to GDP ratio has fallen almost 7 percentage points over a short period, and household debt to GDP ratio has gone up significantly. And when we try to understand this current situation, and the chair nicely put it, that is the quasi banking crisis causing the growth slowdown, or is it a resultant of the growth slowdown? I think to answer that question, we have to go to this root thing, that the consumption growth, which was giving us this fantastic overall GDP growth numbers, that must have been because of this financing that they were getting, and that financing has now stopped. Now, this is where I will make a distinction, that the financing has not stopped from the formal banking system. In fact, I would argue that on the margin, most of the supply side factors on the formal banking system has improved. So if you think of the NPA ratio has fallen almost 2 percentage points. If you look at the NPL coverage ratio has gone up to 60% now. If you look at capitalization, the average capitalization is more than 14% now. If you look at the banking system liquidity, it's significantly surplus. So from supply of credit perspective in the formal banking system, I think things were on the margin improving. We Indians, we like to criticize ourselves a lot. So you will still find enough and more articles which are saying that there are problems with the banking system. I'm not for a second suggesting that there are none, but at least on the margin they were improving. The problem is that the non-banking financial system, which before this improvement started in the banking system, there was a period when the formal banking system was not doing well at all. That's the time when this non-banking financial system crept up without no one noticing it. It was growing at 40% year over year. it has now become 33% of the formal banking system, and none of us were almost aware of it, including myself. I must admit that when last year this IL&FS crisis happened, that's the first time when I created an Excel sheet with NBFC numbers in it. Before that I didn't even have an Excel sheet of NBFCs. So that's where we were shocked by this situation. And what was the crux of the situation? The crux is linked to demonetization. So demonetization pushed in massive amount of liquidity into the system and made the wholesale funding costs significantly lower. So anyone can have 100 crores of capital and can set up an NBFC and go and borrow at 10 times leverage from the market, because the market was just hungry to give money to the NBFCs. And that led to a very peculiar situation also. The peculiar situation is that the banks suddenly realized that NBFCs are getting better rating than the guys that the NBFCs lend to. So it became better for the banks not to lend to that guy, but to lend to the NBFC, and then the NBFC lending to that guy. So in that channel, the bank credit going to NBFC started growing at some fantastic 40-50%. So this was sort of a regulatory arbitrage that the banks were playing on, and the party was going on just fine till the two things happened. One is RBI got a bit worried that this excess liquidity in the system is continuing for too long. So from about March, April 2018, RBI started tightening the banking system liquidity. So the water was gone, so you could now see who was swimming naked. And that's the time also, unfortunately, the IL&FS thing happened. So both these things put together, you had a situation where the NBFCs suddenly found themselves with no one to lend money to them. And because NBFCs for most of the consumer financing items by then would have gone to about 40% of total consumer financing. So suddenly that 40% collapsed, and I'll just give you one number and you will realize how difficult the situation is. April-September 2019 versus April-September 2018, if you take all sources of funding combined, banks, NBFCs, commercial paper, corporate bond, ECB, FDI, everything combined, the drop was a whopping 88%. It's like saying that for 6 months the economy did not have any food for all practical purposes, or was running on 10% food. So it's no surprise that you will see growth collapsing to this extent. So I'll agree with the chair that this was caused by the financial system, but maybe less by the banking system, but more by the NBFC system. Now comes the question that, let me just put one or two other small things about the banking part. I think the banking part, the point that we sometimes miss is that as much as there are asset side discussions, there should be a liability side discussion as well. You will be shocked that today from incremental deposits, 66% of incremental deposits goes to private sector banks, while the stock of deposits, they are only 29%. So this is completely reverse of what Nirupama was suggesting, that in times of crisis, deposits flow to the public sector banks. We are seeing just the opposite happening now. And why is this happening? Because the private banks are in a position to compete among themselves to get those deposits, which perversely is keeping interest rates relatively higher and not letting the full pass through of monetary easing to go through the system. Because the public sector banking system, as Nirupama rightly put it, is a zombie system. It doesn't really matter for them where interest rates are, because they're not interested in doing any business only. So this is one peculiar aspect that we are dealing with, that we are talking less about liability. The other peculiar thing, and this is something which we have to keep our minds open to, is what's happening incrementally to bank NPAs. What is happening incremental to bank NPAs is that quarter on quarter for last 2 quarters NPAs have started moving up, and you have 1 to 3% of banking system balance sheet in telecom, which has a big chance of going NPA. So how that starts impacting the whole thing needs to be taken care of. I think the NBFC side, we might be a bit too worried. Our analysis seems to suggest that the markets are today in the equity market pricing in that 50% of loans given to real estate will go bust, whereas the NBFCs can wait for 20% of the loans going bad before the next capital raise. So there is a bit too much of negativity, pessimism thrown in the NBFC side. Part of the reason simply is that there is lack of data. So if the data is available to everyone, it would be less risk aversion in the system. Now having said that, let me give my 2 bits on what could be done. And I'm going to focus mostly on the counter-cyclical part of it and not really the structural reforms part of it, not because structural reforms are not important. I'm simply saying that today the economy is, as Arvind Subramanian has said, in the ICU. So if something is in the ICU, first think of keeping it alive and then think of treatment. So structural reforms is treatment, counter-cyclical is simply to keep it alive. And structure in counter-cyclical sense, we all know the fiscal space is limited not just because of the deficit issue but also because of the debt to GDP issue, that for the first time in a long period your nominal GDP growth has fallen below the cost of borrowing. So your debt to GDP is now going to explode unless you take some corrective action. So your fiscal policy space is limited, your monetary policy is not getting transmitted enough because of some of the reasons that we were discussing, and perversely your exchange rate policy is completely ineffective because in a demand side slowdown your current account balance is actually improving rather than worsening. So you are, for consecutive 2 years you are going to see significant BOP surplus, which is going to make some kind of an appreciation pressure on the currency rather than a depreciation pressure. So if you look back in last 30 years of 7 mini crises that we have seen, in 6 out of the 7 mini crises the currency has depreciated more than 15% and has become some kind of an automatic stabilizer. This time you are not going to get any support from the currency, most likely not. So my thought process is that you have to get the risk aversion in the system down. There are 3 options for the NBFCs. One is you can have a refinancing window like 2008-9. 2 is what Nirupama was suggesting, some version of an asset management company. You want to call it bad bank, you want to call it PMSC, you want to call it whatever name, para, it's up to us, but very important thing is that it has to be an asset management company and not start lending. Or the third option is what we are trying right now, which is a surgical strike, which is, if you see the total number of NBFCs, it's huge, but only a small would be insolvent, most will be illiquid. So you identify the ones which are the insolvent ones and then take a surgical action on them in trying to find solutions. So we have taken one small step towards that. I would not say small, it's actually quite a big step in getting NBFCs part of IBC. Once you do that, then RBI gets the power to push an NBFC into IBC. They have already put DHFL into IBC. The only challenge is that this you can do only after a default. And as Nirupama's analysis was suggesting, that you can stay tottering on the brink for a pretty long time without actually going into default. So you probably need an FRDI bill now which would set out the early warning signals for NBFCs and let the regulators take action on the back of that. Only then you would be able to sort of clean up this gangrene and the rest of the system will start working fine. And in my view, if the NBFC situation is tackled, risk aversion in the system will come down. If risk aversion comes down, then we should start seeing somewhat better numbers on growth next year. I'll stop here. Thank you.
So I think given the time constraint that we have, I think I would rather we have open it up to the House so we can discuss happy to take your questions. Yes.
This question is like anyone, like Samiran and Nirupama, anyone can. So in NPS, if you see that the larger proportion of NPS is in the power sector. And as you said, Samiran, like right now we need some counter-cyclical measures. But in the power sector, if you talk about the NPS, most of the reforms or measures which are needed are structural. So how do you address this big chunk of NPS in the current scenario? Thank you.
I mean, I think if you go back to Viral's paper on this, he has a specific distinction between two different kinds of asset management companies. And one part is for the power sectors, which will be slightly differently constructed from the rest of the thing. I think we have to even, because his view was that power is a sector where there will, in a country like India, always demand coming back at some point of time. So your asset is not gone. You have to take a medium-term view on things and treat it differently. But if I just digress a little bit from Viral's paper, I think the point about power sector is, where do you start? Power sector, you call power, but it's actually three different aspects to it. There's a generation aspect, there is a sort of a transmission aspect, and there is a distribution aspect. Now, the problem is now mostly in the distribution part. And I think, I don't know whether you are observing this, that in last 3 months, the power demand is down between 10 to 20%. And some people are saying, oh, this is a sign of growth slowdown. This is not a sign of growth slowdown. This is because of one small regulatory change that was done on August 1st. The regulatory change was that now no distribution utility will be able to buy power without providing a letter of credit. So you have to first go to a bank and convince that bank, and that too you can't now buy power directly from a generation company. You have to do it through an intermediary, and that intermediary has no incentive to provide you that without that letter of credit. So what I'm saying is that they've found a pretty good way of stemming further NPS. Now, what is the legacy NPA? It's a tougher one. That probably needs to be solved by the Viral's model. But at least the incremental NPA can now be stopped by this regulation change. That's what my sense is.
Would you like to add?
No, I mean, I don't have.
So the only thing is, it's interesting, although Viral wrote that paper, when they issued that February 12th circular, RBI refused to give any kind of special treatment to power sector NPAs. That was one of the reasons why the entire world ganged up against that circular and brought it down. So that's a footnote to it.
Yes. More questions?
Yeah.
Samiran, two quick questions. I think they're critical in the sense that you ascribe the growth of NBFC basically to demonetization. Can you explain the mechanism that led to that? Secondly, your basic argument as far as the exchange rate, system, this came up even at Nimrana, the question of whether in emerging markets there's a natural, it's all driven by the current account. Basically, you're saying the current account will go into surplus because imports will be compressed. But on the external front, things may get very desperate too. And on the other hand, keeping, let's just say, the lights running and the trains running and the planes, you may not see that type of compression.
So on your first point, let me explain a bit. I'm not for a second suggesting that NBFCs were not anyway growing. They were growing. If you look at the chart on NBFC's share to bank credit, it was gradually growing. It's just that it got a big fillip during demonetization time. And that's because of this reason, that on the one hand, the banks, when they got this liquidity from the system, they are, with 70% being public sector bank, they're risk averse. They had, half of them were in PCA. They couldn't have lent. So the only thing they could do is just pass that money on to the NBFCs. So direct bank credit to NBFCs went up fantastic. In every month, we used to see numbers between 35 to 60% year-over-year growth.
So lazy banking. Yeah.
Just lazy banking. You just passed on that money. That's one part. The second is that this money suddenly started finding its way into other channels also, right? This excess liquidity, it went to mutual funds also. Now, where would a mutual fund put that money in? If it's a fixed income debt mutual fund, you start thinking, oh, great place, NBFCs, darling of the street. So mutual funds suddenly started putting literally trillions of rupees into NBFCs. And NBFCs were issuing all sorts of wholesale-based funding things and getting money. So it became so easy to set up an NBFC that the problem was NBFCs were cribbing, where are the assets? You can't have feet on the street to create assets. That takes time. So they went into a berserk way buying assets. Whoever was there to offer any asset, they were willing to buy. And because you did not do the due diligence enough the way you would do if you were a feet on the street NBFC, you created bad assets. That's why a Bajaj Finance does not have a problem today or a HDFC does not have a problem today, because they have the feet on the street. So their asset quality is much better. They did not buy asset pools. But the other NBFCs which to grow bought asset pools are probably under stress. On your exchange rate question, yes, I get where you're coming from, that the capital flow side could turn adverse. But you know, we are in a very peculiar situation where globally, if you look at the aggregate central bank balance sheets, that has turned a corner back again in October. It was falling for almost 3 years, has started going up again. And we find a very good correlation between this central bank balance sheet size and return from risky assets. So that's why this flow into all sorts of risky assets, including emerging market equities, have increased substantially in the last couple of months. So this is one explanation of why equity markets are much higher compared to where the economy would suggest it to be. And by the way, it's also an optical illusion. It's not the equity markets are higher, it's 10 stocks which are higher. It's not a broader market. But whatever those 10 stocks, they're getting a lot of support from this EM flows into EM. So that can sustain for a year easily if interest rates remain low.
Chetan, you had a question?
Yeah. Thanks. All very interesting comments. So my question is to all of you. So has the extent of the growth slowdown surprised all of you? And since all of you are talking about some kind of financial accelerator, is it your sense that the uptick in growth, when it happens, is going to be anemic and slow, and we're going to be a slow, kind of out of this? The second question is, how do banks develop early warning indicators for NPAs? What systems do they need to put in place to identify that some loans are going to go bad or not? Is it sectoral? Is it what steps should public policy take or banks take to develop these early warning systems?
Nirupama?
So my opinion is that it is the banking sector. All the slowdown is due to the banking sector. So I think we do need to do the hard job of recognizing these bad loans, and so recovery is going to be very, very anemic, as you said. And with regard to whether how do we sort of an early warning system for bad loans? So the kind of data that we have is regulatory data. We know the banks can see these loans are bad, and in spite of that, there's lending directed towards these firms. So I don't think there's that much of a problem in recognizing these bad loans. In fact, these are classified, many of the things that we look at is things like, which are classified as special mention accounts, SMA2. So all the, all other banks know that these borrowers are delinquent, but still there is lending going towards them. So I don't think that is so much of an issue. We already know it. It's just that we need to force them to accept it. And it's usually these provisioning requirements which are keeping them from, from recognizing these on their books.
Okay, so on the growth question, I think one reason why one should be a bit cautious is that, I mean, just to kind of go back, I guess, since 2014, 13-14, because we had one crisis in 13. So we had two kind of tailwinds for Indian economy, right? One was the oil prices came down, so that itself helped growth. The second was, of course, this post-demonetization, this whole NBFC boom, which happened, a very short-lived boom. So obviously we are kind of, both of them are behind us. The oil thing is not going to repeat, and it doesn't look like even on the NBFC side, even if we do some kind of a surgical strike or whatever, I think the guys who was, the NBFCs which are still remaining, now they're also going to become more cautious. So therefore, we are not going to get that kind of a tailwind. So that is the reason why I don't think that the recovery in growth, when it happens, we are again going to go back to a 7 to 8% kind of a growth, just to put a number. Of course, there are question marks about the numbers themselves. So we need to find some new source of growth. So that is the issue. Now, on the NPA question, my sense is, of course, I mean, this is, again, as an observer, is that when banks do the typical banking things, like worldwide what banks are supposed to do, that kind of a normal banking when banks do, I think it's much easier for them to manage their assets, which is when lending to consumers or to small firms. It is when banks in India started lending to infrastructure, started lending through the NBFCs, lending to the real estate. It is the big chunky loans when they lend. I think that is where the problem has come from, because there is extreme reluctance to kind of book it as an NPA and then go after those borrowers, maybe because they're politically connected or for whatever reason. So I think that is the issue which we are struggling with, how to fix that. So if you kind of tell that banks cannot do that kind of activity, who's going to do? Because somebody has to do, because infrastructure, leave real estate to one side. Infrastructure is something which needs funding. So we earlier had a development financial institution model. We moved away from it to a universal banking model, and now we are finding that banks are not capable of doing it. So I think that is the puzzle now, how to kind of fix that.
Sorry, very quick responses to your first question. I think from a counter-cyclical policy perspective, both monetary and fiscal, we have done quite a lot. I see two areas where I'm a bit concerned whether this counter-cyclical policy will have its effect or not. One is that we have a very large informal economy which is less sensitive to stimulus, and maybe that segment is also impacted the most by these structural reforms that you were talking of, which in the short run has a growth cost. So, and because we don't have any high frequency data on them, we don't even know how bad the situation is. So that can keep on dragging down the overall growth despite the formal economy benefiting with a lag from the stimulus. And the other part is that if the overall leverage in the system is too much, then the stimulus might not also have the desired effect, because in that environment, nobody would want to take any further risk. And without taking risk, the cycle will not turn. So these are two areas where I think I'm a bit worried that all of us, we are forecasting some sort of a gradual recovery next year on the back of this stimulus and on the back of favorable base effects. But that might not work out if these two things become too much of headwinds. And on early warning signals, I can say that most of the private banks, and I have worked in, and I've worked in quite a few of them, they're pretty sophisticated teams which do this analysis. What we hire from places like ISI, and those are the guys who do that analysis quite well. Maybe more number of public sector banks have to put in more resources in getting this done. This is not rocket science. World over banks do it. I can't believe that India is so unique that we will not be able to do it. It's just a matter of resources.
Yes, please.
So I think my question is more to the practitioners in the panel. So I have two questions. One on evergreening of loans and intercorporate debt from the parent to the subsidiary companies. What are ways that we can identify this, and what are ways that we can tackle this? The second question is on the FRDI that you mentioned specifically as an early warning indicator. So could you elaborate on that a bit more?
So I can take the second question first, and first one is tough for me. I think Nirupama is you are probably the best person without being a practitioner to answer it, because you have done research on these things. So, the challenge that we have today is that a DHFL can be taken through an IBC process only because DHFL has defaulted. Now there might be, and Prasanna was showing in charts the HFCs, all those HFCs for all practical purposes are tottering on the brink, and if you keep on letting them stay there, it will affect confidence in rest of the system. So you can have, like in the banking context, we have the PCA framework, which is like an early warning system to take corrective action. Similarly, for NBFCs, we need some early warning system to take corrective action on them. Right now, the regulators don't have any power, direct power. So Governor Das in the last press conferences said that we are tracking the top 50 NBFCs, scrutinizing them, and we are calling their promoters to RBI to directly one-to-one tell them what needs to be done. Now this is moral suasion, nothing beyond that. It needs to be more structured if you can do it through FRDI. Unfortunately, FRDI has got so tainted that I don't think the government will be able to pass FRDI in the current version, but there is a need for FRDI. The other question, honestly, I'm not an expert, so I don't even want to attempt.
So, Nirupama, you want to take that?
No, I think it's a data question, right?
No, it's not a data question.
What's
It's,
the question?
On evergreening, how do we identify evergreening?
no, not evergreening, only the parental part of it.
So evergreening,
It's
I
a-
think, has changed now, right? I think RBI has tightened the rules on asset recognition. So after the AQR of 2015,
Is that effective enough in practice?
I would think so, yes. I mean, in fact, that is one of the reasons why credit growth has actually slowed. So earlier it was optically higher because of some of these practices. That has changed now, and that's why it's slower. The parent to
The parental what, look, the challenge is that you look at I'm just giving a slightly off example, which are the NBFCs which are doing well. All those NBFCs have parental support, right? So it happens similarly on other kinds of lending also. The bank gets a comfort, sometimes explicit, sometimes implicit. And if I'm doing a risk modeling for a bank, I have to take this factor explicitly into account because the market does. If I go completely against the market and not taking this factor into account, I will give off pricing. And I will not be able to grow business. So the more and more I see bankers are insisting on explicit guarantees than implicit guarantees, which is a positive sign. But if you ask me, will it go away ever? I don't think so. It's going to stay. More and more people will want everything in black and white. That's the only change that can happen.
So just to add to the evergreening part, I think it's true that technically that's RBI recognizes a very specific thing as evergreening. But when you think about like the literature itself, we also think about we're also concerned about things like zombie lending, which is you just want to see whether there is a firm that does not deserve credit and is getting subsidized credit. So usually we look at things like if it gets loans at interest rates lower than the highest rated firms and things like that. But yeah, the very specific evergreening that RBI defines it, that's being.
So one of the things also is that this evergreening seems to have migrated to NBFCs and HFCs, right? So the real estate lending, the lending to real estate developers, I think a lot of it is just evergreening. So you just keep them alive so that they keep paying you the interest, and obviously with the hope that they're able to liquidate the assets or whatever, or they're able to generate incomes in the future.
Yes, please.
So I have a question for Samiran. When you started your talk, you mentioned about consumption-driven growth. So still wondering, I'm not sure exactly what you attribute that to. How did consumers spend? Was it saving less or was it?
Yeah, so saving less and borrowing more.
So you're saying it's saving less?
So your household savings to GDP ratio fell from 24% to 17% over a 5-6 year period.
This you attribute to general optimism, because if their incomes are not going up, why would they be consuming more?
I would probably ascribe this more to some sort of a ratchet effect. that you were used to a certain consumption basket, sometimes even aspirational consumption basket, but your job and income growth was not supporting you to get that, but you still have to consume. And this is, in an odd way, just again digressing a bit, explains why iPhone sales are going up when car sales are not. Because you are now aspiring to hold an iPhone, not aspiring to buy Maruti's lowest end model. But there was a point of time it was reverse. When you were aspiring to hold any damn car rather than doing something else. So it changes from time to time what you want to consume, but clearly there is an aspirational consumption basket that drives you to spend more than what your job or income growth would suggest.
So, I sometimes wonder if it is not just a simple Keynesian economics at work, which is that investment has dropped. Now, if you just abstract from growth and look at it as a static model, then we know from Keynes that a fall in investment leads to a fall in income and therefore a fall in savings. So fall in savings is a consequence of fall in investment. So it could be what you are saying, it could be that it is the slowdown process which is leading to the fall in savings as a result of fall in investment.
I'll give you two other explanations of the fall in savings, and interesting for you academics that you can work on these things. One hypothesis is that this is connected to RBI's inflation targeting. So what has happened is, and I'm giving you a practical example, you know, these financial advisors come to your house for your sort of pension planning, retirement planning. So earlier, they would always come and in the Excel sheet when they put their inputs, they would put inflation over the next 25 years at something like 8-10%. And through that, they will arrive at a retirement corpus for you. Now they will put that number at most 6% inflation. The moment you do that adjustment and with compounding, your retirement corpus required comes down very substantially. So in an odd way, you don't need to save that much. And the other thing that could be happening is that the current generation is, I call them second generation wealthy, if not the third generation wealthy. So your ability to borrow in an overlapping generation sense is now much more. You know that even if you can't pay your EMI for 6 months, your father can pay your EMI. But even in my generation, if I had no money to pay my EMI, I don't think my parents were in a position to pay it. So that support is making people that much more confident or comfortable in taking leverage. Yes, thoughts?
So, yes, please. Mike here, please.
Yeah, no, very interesting listening to you all. Just a follow-up on this basic storyline, Samiran, that you sketched out, that a lot of the recent upsurge in growth is through consumption being credit financed and through NBFCs and so on. And because of problems with the NBFCs, you know, that channel has kind of dried up, that's one of the reasons for this, the mess we are in. I mean, you know, but what's the, but in some ways the next round of question is then, you know, can one have sustainable growth which is basically on the back of household debt? I mean, are we reaching a limit? So even if you revive the NBFCs, I mean, is that, okay, it might do a short-term revival, but are we reaching a sort of limit to that kind of growth?
You know, my mind has changed a lot on this question, and I'm still in a flux, to be honest. Where's the problem? The problem is a data problem. So we have worked with always a BIS data on household debt, which shows that household debt has gone up from about 9% to 11% over this period when this household savings has dropped. And I used to tell myself that 11% household debt to GDP compared to rest of the countries in the world is so low that we can continue doing this for some more time. And I'm not bringing in the debt servicing angle here. Maybe our per capita income is a little lower, but even if we adjust for per capita income, we can still do this for a while. But there are now some studies coming out which is showing that this BIS data is wrong, and our total household debt is closer to 31%. 11 and 31 are not comparable. So in 31%, this story goes out of the window. So I'm waiting for some clarification from RBI on this. I've been told that it's going to come very soon, that what number we should be taking, whether we should take the 11% or we should take the 31% or somewhere in between. So I will probably give a better answer to your question once that happens. But having said that, I did not comment at all on the structural reform side for a specific reason, because we are not discussing that. The fact of life is that we have to create jobs and income. And even if you for a moment say that number is 11% and we can go to 20% on household debt, that's a 3-year issue. After that, what happens? And that's an area where I don't think we are doing a great job.
So just to add to that, I think probably the question what you're asking is where is growth going to come from? I think this is a consequence of just depending on top 10 or 15% of households. So I think Professor Ratin Roy has written about it quite extensively on this. So what he calls a structural demand problem, right? So all the growth has come from only the top 15%, and we have not focused on the bottom of the pyramid. So now the idea is to broaden the growth, is to focus on that, to have policies to, and I guess some of the structural reforms which Samiran is talking about will feed into that. So that is how you broaden drivers of growth.
Yes, please.
Do you think there is a role for more aggressive monetary policy? I mean, yes, the repo rates have come down by 135 basis points, but so has inflation. And yes, we have seen a little bit of food inflation now in past few quarters, but core inflation remains still too low. Also, is there a scope for unconventional monetary policy like quantitative easing to just, keeping the patient alive, basically?
Prasanna, would you like to?
So purely from an interest rates point of view, I do think the space is limited. I mean, I don't agree that the rise in inflation is only food. I think there are other items which are going up. Now, of course, these are not demand driven. It is telecom. There is some correction happening for 2-3 years of disinflation. Maybe GST taxes have to go up because we peg the taxes low. That's what the government is thinking. So these are more of supply side kind of issues, but still ultimately it means that inflation will go up and the MPC has to respect its mandate. Now, whether QE kind of a thing can work, I guess it makes sense to try. My sense is it has to be tried along with a fiscal push. So which is something which people kind of miss out when they look at US. When the Fed eased, the US government is also spending, the fiscal deficit was expanding. So it kind of coincided beautifully, which is something in Europe they didn't do. So that is why Europe has not recovered and ECB is struggling. So it has to be a fiscal monetary push. It's a combined push. Of course, the RBI, when they do it, I think they should have the autonomy. When they see the warning signs, they should be able to pull back. I think the problem in India, and we tried something like this in the earlier 2008 slowdown also, right? You do coordinated stimulus, and then when the time comes to pull back, you don't do it, and that sets the stage for the subsequent bust. So I think that is a big issue, whether the RBI has enough autonomy to do that. So that is where the reservations come from.
I'll just take 30 seconds to add something, and this is not directly an answer to your question, but think about it that the whole economy, any nominal variable that you take, has gone through a significant deflation. Whether it is inflation, it is wage growth, deposit rate, you're mentioning profits. Profits are down to 3% from 10%. You take equity returns, all the nominal variables have come down. But so from this equilibrium, you move to this equilibrium, but the mindset has not changed. So if you think of a depositor and you tell him that deposit rate, bank deposit rate is 6%, you will say, I'm never going to put money in banks. But he's not thinking that my real interest rate is still significantly positive. It's only us in this room, we think of real interest rate. I don't think the world truly understands real interest rates. One of the learnings from me when I walked out of this place into working in the corporate sector, this is one thing I've understood is that real interest rate works in theory, it doesn't work in practice. Sorry. So this is where we are in a flux because the policies are not having their desired impact because the policy can only have a desired impact only through expectations. If people are not changing their views or their perceptions, then the policy is stuck in between. And that's probably one of the reasons why even we are not seeing the full transmission of rate cuts, etc.
So there's a need for an awareness campaign?
Yeah, it's almost like that. People have to be told that, look, at 6.5 deposit rate, you are quite well off. People have to be told that if you get 8-9% return in equity market, that's fantastic in today's world. People are cribbing that, oh, 15% milta tha. Where is that money? So people are feeling depressed. The consumer sentiment is low is partly because of this reason also. That they are thinking that on all sorts of assets, the returns are extremely low.
So I think we'll take one more question, last question, and we'll wind up there.
Maybe I can ask the last question.
Okay.
So just a show of hand, how many of you think that next year's GDP growth will be 6%? Oh my God. We have spread a lot of gloom and doom, it looks like. Nobody is even...
No, I think their answer is that we don't know. They're not saying either way. They're just saying, these are researchers. So the answer is that...
be forecasting also. Researchers can't just be researching, they have to forecast.
On the one hand can be, on the other hand may not.
Also after your talk, we've revised it downward.
Yeah, that's why I'm saying we have spread a lot of gloom and doom. Thank you again for the opportunity.
Thank you.
So with this, our 15th annual conference comes to an end. So just give me 2 minutes to do the formal vote of